The Department of Education might be about to hand over chunks of the $1.6 trillion federal student loan portfolio to private companies. And if you own SoFi stock or you've been watching it, this could be the single biggest catalyst the company has seen since the pandemic pause ended. Now, if you're short on time or you just want the headline, here's what it means. This policy shift could unlock somewhere between $5 to $10 billion in annual refinancing volume for SoFi alone, which translates to roughly over $100 million in first-year profit contribution. That's not small change for a company trading at a $30 billion market cap. But stick around because I'm going to walk you through exactly why this matters, what the number actually says, along with its recent technical picture. Oh, and a quick intro for those who are new here. I'm DataCat, former corporate analyst, spent some years buried in messy data and models, eventually, reluctantly, traded the cubicle for, well, this. I'm about 2 months into this YouTube thing, still figuring it out honestly, but I'm here to share what I find digging through data and markets. Not financial advice, just one introvert with a keyboard and way too much coffee. If you find this useful, hit that subscribe button. It actually helps more than you'd think for a small channel like mine. Alright, let's get into it. So here's what's happening behind the scenes. The current administration is reportedly exploring selling off what they're calling high-performing slices of the federal student loan portfolio to private buyers. We're talking about loans where borrowers are actually paying, not the ones in default or perpetual forbearance. Now, why does this matter? Because for the last few years, federal student loan repayment has been, let's say, optional. Payments paused, forgiveness programs floated, income-driven repayment plans expanded. Borrowers got comfortable. But if the government starts selling these loans to private entities and shifts management away from the Department of Education, that's a signal, a big one indeed. It basically means the era of leniency is over, repayment is back, and forgiveness isn't coming to save you. And here's the thing. When borrowers realize they actually have to pay and they're staring at 6, 7, 8% interest rates on federal loans, suddenly refinancing to a lower private rate starts looking pretty attractive. That's where SoFi comes in. Now, let me give you some numbers to frame the scale here. The federal student loan balance sits at $1.6 trillion spread across roughly 45 million borrowers. Let this settle in a bit. Even if just 1% of that portfolio converts into private refinancing, just 1%, that's $16 billion of potential loan volume flowing into the private market. To put that in perspective, the entire private student loan refinancing industry does maybe 20 to 30 billion a year in a good year. So we're talking about a meaningful structural expansion of the addressable market. And look, I get it, 1% sounds conservative, maybe even pessimistic, but that's the whole point. Even at the low end, the numbers start to get interesting fast. If SoFi captures, say, 30 to 40% of that flow, which isn't crazy given their brand and digital distribution, you're looking at 5 to 10 billion in annual originations just from this policy shift alone. Now you might be thinking, okay, sure, the market expands, but why SoFi? Why not one of the big banks or legacy services? That's a fair question. Let me walk you through SoFi's advantages here because they're not small. First, funding cost. SoFi has a bank charter, meaning they have access to low-cost deposits, checking accounts, savings accounts, the stuff that costs them maybe 1 to 2% to fund. Compare that to a non-bank lender who has to go to the capital markets and pay 4, 5, 6% or even more depending on conditions. That funding advantage alone lets SoFi either price more aggressively to win share or pocket better margins, or both. Second, distribution. SoFi built its brand on student loan refinancing before 2020. They have a high-intent, digitally native funnel. Borrowers come to them already looking to refi. That's way more efficient than cold calling or buying leads. Lower customer acquisition cost, higher conversion rates. Third, let's not forget about its cross-selling abilities. SoFi doesn't just want to refinance your loan and wave goodbye. They want to move you into a checking account, get you using their credit card, maybe open a brokerage account. Every product you add increases your lifetime value to them, and makes the initial cost of acquiring you as a customer pay back faster. That's the flywheel effect people keep talking about. Lending feeds the ecosystem. The ecosystem feeds lending. Fourth, capital markets execution. If private buyers start piling into student loan asset-backed securities because the government is legitimizing the asset class again, that tightens spreads. Tighter spreads means SoFi can sell those loans into securitizations at better prices, which boosts their gain on sale margins. They make more money per loan without taking on more risk. And here's a bonus that most people aren't mentioning: optionality. SoFi isn't a legacy federal servicer, so they're not getting the servicing contracts directly. But if the government does sell whole portfolios to private buyers, there could be opportunities down the road. Sub-servicing partnerships, portfolio purchases, who knows? It's not the base case, but it's on the table. So you stack all that up: funding advantage, distribution, cross-sell, capital markets execution, optionality, and SoFi starts to look like the best positioned player in a market that's about to wake up from a 3-year nap, just from this angle alone. Now, before we get to the technicals and the trade setup, I want to address something. Last week, SoFi pulled back about 10% from the highs. We talked about this stock a couple weeks ago, discussing how it could go up to $30 in the current environment. Honestly, it went up quicker than I expected. I didn't make a video to celebrate the win and went quiet during that dip. Here's why. It was technical. No new fundamental news, no earnings miss, just profit taking after a run. Honestly, I didn't think there was much to say. I didn't want to make a video just to repeat, yep, stocks go up and down, because that's not useful content, and frankly you deserve better than that. Turns out the pullback was short-lived. SoFi recovered fast, and now we're sitting near new highs again, with an actual fundamental catalyst layered on top. And that's an important lesson here. If you have conviction in a thesis, a normal pullback shouldn't make you panic. Stay informed, do the work, and don't react to every 5 or 10% move like it's the end of the world. Stocks breathe, especially with high beta growth stock. It's perfectly normal. What matters is whether the underlying story is intact. In SoFi's case, it was. And now we have even more reason to pay attention. Alright, enough with that, let's talk charts. So on Tuesday, SoFi gapped up and ripped over 6% on volume. That was 76% above average. The stock gapped up at the open and held those gains all day. That's a gap and go breakout, and it's textbook bullish when it happens on heavy volume with a catalyst. Let's recap the context here. SoFi has been in a confirmed uptrend for a while now. A golden cross happened 78 days ago. Price is now 62% above the 200-day, about 12% above the 50-day, and 5% above the 20-day EMA. All of that simply says strong trend, momentum intact. The stock is also sitting at 90% of its 52-week range. It's only about 7% below the all-time high. So we're in blue sky territory here. Next resistance, the all-time high. After that, there's not much on the chart to stop it. Momentum indicators are recovering nicely. RSI bounced from oversold levels around 42 on October 3rd up to 59 on October 7th. MFI climbed from 28 to 48. That tells you money is coming back into the stock, but we're not overbought yet. There's room to run. MACD histogram is rising from negative territory. Early stage bullish crossover forming. Volatility is elevated. 10-day historical volatility at 54%, but that's manageable. I would view this as a significant high conviction move. Now intraday, the stock closed 6% above its VWAP at 26.52. It usually means the buyers are still in control, perhaps a sign of strong institutional accumulation. And the key levels to watch: resistance at 28.84, which was the intraday high, support around 24.80 to 25.45, and critically, holding above that 26.50 WAP level. If we break below all these levels, it could signal a fade. One thing that gives me a little pause: the on-balance volume, which tracks cumulative buying and selling pressure, has been sloping down over the last 20 days. That suggests some profit taking and distribution during the consolidation phase, which fits last week's picture. But the October 7th volume thrust, 28% above the 5-day average, might mark a regime shift. We'll see. And the bottom line on the technicals. This is a textbook breakout on a fundamental catalyst. The trend is strong, momentum is recovering, and we're sitting just below all-time highs. But technical-wise, the stock is extended short-term. It's not a screaming buy at $28 if you're trying to minimize risk. So, what do you do with this information? Remember, this is definitely not financial advice though. If you're looking at a 6 to 12 month position trade, here's how I'd think about it. Current level, around $28, is acceptable if you have high conviction on the policy catalyst and you can stomach a 10 to 15% drawdown. But I wouldn't go all in here. Size conservatively, maybe 2 to 5% of your portfolio, because there is binary policy risk. If the administration walks back the privatization plan or legal challenges tie it up, the thesis weakens fast. Better entry, wait for a pullback to $24 to $25, which is around the 50-day moving average. That's your support zone. If we get macro noise or policy headlines fade and the stock dips, that's where you want to add. Upside targets. I trim some position into $33 to $35 to lock in gains. Hold the rest for a potential move to 40 plus if the refinancing cycle fully materializes by 2026. And stop loss? Not necessarily, but a break below 24.80 on an intraday basis or a daily close below 25.10 would negate the breakout. At that point, let's reassess. Don't marry the position. With all that said, let's be honest about what could go wrong. As mentioned, a policy whiplash. If the administration reverses course or legal challenges delay the sales, the catalyst evaporates. Then, adverse selection. If the portfolios sold to private buyers are structured in a way that keeps most of the economics with the Treasury, the private market doesn't deepen and SoFi doesn't benefit as much. And last, competition. Larger originators and servicers could wake up and compress margins across the board. Any of those would change my mind on the thesis. So stay flexible. And here's what I'm watching over the next 2 to 4 weeks to validate or invalidate this thesis. 1. Formal proposals or RFPs to sell high-performing federal loan cohorts. Any concrete policy action, not just headlines. 2. Further rollbacks of forgiveness programs and durable restart of collections. We need to see borrowers actually paying again. 3. Student loan ABS issuance volume and spreads. If we see more deals pricing and spreads tightening, that's a green light. 4. Any SoFi commentary on refinancing funnel growth. Earnings calls, potentially in Q4 investor presentations, management interviews, listen for language around demand inflection. 5. Intraday technicals, watch that 2650 VWAP level. Hold above it, bullish, break below, fade risk. Look, the technical and fundamental alignment here is strong, though not perfect. The stock is extended, policy timing is uncertain, and valuation leaves little room for disappointment. Best risk reward in my view. Wait for a 5 to 8% pullback to $26 to $27, or scale in now with a smaller position and add on confirmation. If policy headlines accelerate or Q4 earnings surprise, the $30 to $36 path is credible over the next 6 to 12 months. If news fades or macro sours, expect a test of $24 to $25 support. And that's all for today. Again, I'm just a random guy with a laptop trying to make sense of markets. If you got value out of this, subscribe, hit the like button, drop a comment if you have thoughts or questions. I read all of them, even if I'm slow to respond. Introvert problems, you know. Cats aren't exactly known for their social skills. Don't just trust a random guy on the internet, do your own research, and I'll see you in the next one. DataCat out. Stay safe and stay sharp out there.